Okay.
Got it.
Right. Okay. Yeah, it's going on. Okay. I'm just make sure it's silent.
Right.
Right. Okay. Hi, everyone. Welcome to my first live stream interview. And my guest is Mr. Tian Pan. This is Uncle Kevin here. And thank you for joining us at this time, lunchtime, South Africa. And wherever you are, maybe around the world, welcome. And first of all, I just like to inform you that I'm still learning about live stream. So if the process is not as smooth, or I forgot, I didn't attend to certain aspects, please understand as I'm still learning about this process. But I'm honored to have my good friend, Tian Pan, joining me on this session as he talks about China, Shanghai, current lockdown that we all are watching the news and concerned about. And so I invite him to join the session. Yeah, this the wonderful thing about load shedding in South Africa. We just, my office where I am now, we just got into a load shedding, but the generator is going to kick in. So hopefully that we can continue with this live stream without problems. So there are 101 things that could go wrong with a live stream. And South Africa, one of the things that's for sure we need to be thinking about is load shedding. Well, yeah, the generator kicks in and we are now back with the lights. Okay. Tian, thanks very much for joining us. And I have some questions I'd like to ask you. And sorry, it's my printer at the back. It's just restarting with a generator power on. Okay, so Tian, how are you doing in Shanghai? I believe that you're at home and you have been in this lockdown phase for some time. Can you first tell us how you're doing and how what it's like, you know, because in Shanghai right now?
Great, thanks, Kevin, for having me. Yeah, it's been somewhat of a reminder of South Africa's lockdown in March. I think that began in March 2020. So it's actually haven't affected me as much as some of the other Shanghai residents. So most of our office at Prescient here in Shanghai went into lockdown at home on the 1st of April because we stay on sort of close to city center on the west side of the river, of the Huangpu River, Puxi side. So we've been locked down since April 1st. Actually, one of our colleagues is already out free, although none of the shops are open. So effectively, very similar to South Africa. The only difference is we can't go out to buy groceries. Food is being delivered to our apartments, to our complexes. Certain, there's definitely been sort of news of different sort of experiences in different areas. Remember, Shanghai is a city of 26 million permanent residents. Estimates are that including non-registered residents, it's a city of over 30 million people. So it is massive. So it's half of South Africa's population crammed into the city. So we've definitely heard, even amongst our friends living in different complexes, that there's vastly different experiences in terms of how they are handling this lockdown. We have one friend that's been locked down for over 40 days now. I'm currently day 13 of my lockdown. I'm already starting to feel a bit frustrated, but hopefully we'll be out in another week or so in our complex. And it's been managed pretty well. Most of us at the office living in areas where sort of local governments are managing, or local, if we compare it to the South African system, local ward management, pretty efficient. Food supplies obviously not as abundant as pre-COVID times because you can't order takeaways. There's no sort of Uber Eats or whatever the equivalent. So it's a bit frustrating. So no luxuries of life, but in terms of
Okay.
sort of daily life, it goes on. Now I've actually, let me try and share something. I've got a couple of photos.
Okay. So have you, Tian, have you lost weight because of lockdown? Now that you couldn't enjoy all the...
Lockdown's a bit difficult because there's no movement. I literally, I was worried that I would pick up weight because I literally spend no calories every day. But I've been doing virtual workouts with friends at gym. So I've maintained my weight. Weight. Hopefully I don't look that bad. But just to show some photos, this is actually what I showed in our webinar yesterday, is that this is sort of a picture. So within a complex, we get tested pretty much every second day by official PCR tests where they swab your mouth to test you for COVID. I mean, aside from the frustration of having to take it every 2 days, all the doctors come to your complex. It's all organized. There's no cost. Government funds everything. So from that perspective, it's very efficient. So as I say, aside from the frustration of not being able to go out, it's being managed pretty well, at least for myself and all other colleagues from the Prescient China office. In terms of this map is a month old. So this is typically the map that I show friends, also clients, that you can see the red dots are all the positive COVID cases across Shanghai. It seems like COVID zero is going to be a very, very difficult policy to pursue, but the government's very adamant and they're pushing very hard for it. So we'll be able to see what the next steps are after another couple of weeks, especially given. So there's been actually 0 deaths in Shanghai due to COVID. There have been deaths related to the COVID lockdown. So it's a fine line of difference, but no actual deaths due to COVID in Shanghai so far reported. So I mean, that's it. And then we also have home test kits. So every second day we get an official test, and then every other second day we have to test ourselves. So this was my first home COVID test. I think I thought it was pretty interesting. I think this was yesterday or the day before. This was sort of my 10th COVID test. You can see my mood is definitely affected. And I saw this interesting thing on Instagram. So it's pretty true. It says never ask a woman her age, a man his salary, and don't ask people in Shanghai when the lockdown will be over. So that's kind of the situation.
Okay. I'd just like to know, how many tests have you done so far?
So one every single, so 13 tests altogether, I think. Actually, I was supposed to go for my 13th test. But it's raining. The weather is pretty bad in Shanghai today. So they've called off tests for today. So I think they'll come back tomorrow.
Okay.
So it's very, very strict. It's a bit difficult. A lot of compounds, complexes, they pretty much fully negative, but because Omicron is very transmissible, you always have to have goods like food being delivered from outside the area. There's always contamination. So the complex can be COVID free for 10 days, and all of a sudden there will be a positive case. That makes it another medium risk area. So the lockdown never seems to end due to that. So that is an issue, especially in Shanghai. When I talk about a complex, it's not what we imagine in Joburg or Cape Town. A complex here typically anywhere between 5 to 20,000 people in a complex. So when you're looking at any one person out of 5 or 20,000 people, it's a very, very high chance that you'll get it, given Omicron is very easily transmissible. So that's the sort of tough situation we faced with right now.
And in terms of the situation you are in, and I'm just thinking about China's policy in terms of COVID zero, but you know that we have moved quite far, you know, in terms of with the virus and also with the variants. You know, initially the Delta or the Beta or whatever, Alpha, it was quite deadly. But now, if you look at Omicron, it's highly transmissible, but it's quite mild. in comparison.
Mhm.
And I know this in China they tested like a subvariant of Omicron. If the trend is that the symptoms are mild or is like even like no symptom, wouldn't the Chinese government consider a different strategy, changing its strategy instead of continuing with this path? Because certainly the virus has changed so much compared to 2 years ago.
Yeah, so definitely, absolutely agree with you there, Kevin. So our view, especially taking experts' opinions into account, the death rates, actually, as I mentioned earlier, there's been 0 deaths, and probably official numbers reported probably close to 300,000 cases of COVID now, with 0 cases in Shanghai, with 0 deaths, or in almost 300,000, which is something that's very encouraging. What I think the Chinese government is pursuing, firstly, I think we need to understand that the people think pretty differently in China than they do in South Africa. So I think there's probably 2 main reasons why I don't see a quick end to the COVID-0 policy. First is that the government has restated many times, central government, including President Xi himself, that COVID-0, or what they want to call dynamic 0 now, is what they want to pursue. Even though the death rate percentage-wise is very, very low, in the government's official words, I'm not quoting exactly, but somewhat trying to quote what the government has come out to say publicly, is that as a socialist economy, an economy that tries to focus on the well-being of the people rather than just economic output, even at sort of a 10 to 50 basis point death rate, it's still going to end up being a lot of deaths when you have a base population of 1.4 billion. So that's one thing. And then also, I think we obviously have been through very different experiences in the West through the COVID pandemic. I think in China, I must say, the majority of the public really supports the government initiative in terms of pursuing COVID-0. So one thing, for example, what we often speak to at the office is that we're very frustrated that we can't visit South Africa, we can't travel. But official stats say there's only a little over 100 million people in China with passports. So out of 1.4 billion people, more than 90% of people don't have passports. So that means they've never traveled outside of the country. So effectively, this COVID-0 strategy only affects a single-digit percentage of the Chinese population, and not in terms of necessity. So for example, if I need to travel for work, that's seen more as a necessity, but for most people, it's for traveling for leisure. So in terms of that, that's why there's not too much pressure on the Chinese government to change right now. Shanghai might end up being a tipping point on sort of policy-making decisions, but I'm not certain of that. We'll have to wait and see. What we have seen is that Hong Kong has really eased their travel restrictions, and that might be a sign for mainland China as well. And personally, I'm quite hopeful for that. We've also seen big moves by Singapore and Southeast Asian countries, so Thailand, Indonesia, Singapore, Thailand, sort of economies with close ties to China. So as Asia gradually opens up, we expect the Chinese policymakers to sort of rethink. But in the near future, the government's come out various times to publicly state that they continue to pursue what they call dynamic 0. So that's what we can expect for the near term.
Right. Tian, I saw a picture of 2 of like all the ships outside, container ships outside Shanghai, the various ports near Shanghai because of the lockdown situation in Shanghai. So as Shanghai is the gateway to the world for China, and also it's like for the world, it's the gateway into China. So how the current situation going to affect the near-term economy? I don't think this is going to be a long-term situation, but in the near term, definitely there would be an impact on the economy and also about the world trade, isn't it?
Yeah. So Shanghai lockdown is still sort of a partial lockdown. So that's the positive.
Okay.
So for example, port activity is not affected.
Right.
Port activity is not directly affected, although port efficiency will be affected. So it's not running at 100%, but it's still running. So they might be loading slower, etc. A lot of ships parked outside of Shanghai port. To be honest, I'm not sure how that compares to previous. Shanghai's, I think Yangshan port, that's the biggest port in the world. So there typically would be ships parked outside quite a lot. There will always be a queue. So typically what's used as a comparison is recently when the US or at least US media outlets mentioned that there are supply chain issues in China. When we had a look, I mean, Chinese export stats last year were through the roof because they were taking over production capacity from Southeast Asia that were being shut down. And when you look at sort of really busy ports in the US on the West Coast, and there's also massive queues. So to be honest, I'm not an expert in that, but what I am aware of is that the port is fully functional, probably not as efficient. I know that shipments coming from inland China to Shanghai port is sort of a slowdown because there's checking of permits, etc. Coming into Shanghai. So there's a massive queue on the highways. But I mean, it's operating slower, but that shouldn't be the main issue on the economy. Shanghai's financial services sector is still running at full speed, pretty much. Stock market is still running, futures exchange still running. So all of that is fully functional because that can all be remote. What's really suffering is the manufacturing capacity in Shanghai. I think there's no official estimate, but that'll be hit very hard. The services sector, the physical services sector will be hit very, very hard. I actually read a study that's come out from a joint study from various US and Chinese universities that the current lockdown, not just Shanghai, Shanghai and Jilin, so northern city and actually northern province in China, is that the estimated cost of these lockdowns is about $46 billion a week. So when you're considering China's economy at sort of 17-18 trillion, it's quite an impact if it goes on for quite a while. I mean, it's not as big as if it's $46 billion on South Africa's economy every week, but it's still every month you're looking at a couple $100 billion lost in economic output that needs to be caught up somewhere. So it is something significant, and I'm hoping government will take that into account.
Yeah, you mentioned about the sector that's being impacted. I could only imagine like now you talked about like Uber, the Uber Eats delivery and all these drivers. They now don't actually do they have a job? Can they actually make income now? I suppose
they're doing great actually, but it's only for those drivers that have permits. So you need a permit to be delivering. And typically people are being tipped massively. So for those, not everyone can get the permits, but for those who have permits, there's been sort of probably not rumors, but reports and screenshots of riders getting delivery fees plus tips averaged around 10,000 yuan a day. So that's earning around 25,000 Rand per day. So that's a very good income. I mean, typically they would make the same amount in a month delivering goods in Shanghai. So it's very good for those that do have a permit. That's true. But not everyone has the permit. So that's the problem.
Tian, please excuse me, I forgot to introduce you properly at the beginning. So Tian Pan, he's the head of product at Prescient China. And Prescient China has been located in Shanghai for many years. And they focus on the China strategy and investing in China. and with a team of I think it's about 5 or 6 people, and all highly qualified, all with a South African roots, and doing great work, research and portfolio management for clients based in Shanghai. Okay, so Tian, my next question is that over the last few months, especially since the Ukraine war started, we saw like Prosus and Naspers share price just fall off a cliff. So over the last 12 months, Prosus and Naspers share price fallen by more than 50%, and obviously that they are the big shareholders of Tencent. And their fortunes a lot of times linked to Tencent, and Tencent, they're also being subjected to the Chinese government regulations. And I think the last 12 months about, if we can call it like kind of crackdown on the gaming and the various tech sector, and also in line with China's policy of a common prosperity. How has that been impacting Tencent fortunes? Especially the tech sector in general, like Chinese tech giants like Alibaba, Tencent, Meituan, Jingdong, etc. What's the future of the tech sector in China? If you look at from a PE ratio point of view, is compared to the tech giants of America, like your Amazon and the Tesla and your Meta, then you feel that the Chinese tech stocks are certainly very well priced at the moment. But it seems like there's no bottom. Do you see this is not right now around the bottom, or can we see ever like a light at the end of the tunnel for our Naspers and the Prosus investors in South Africa?
Okay, let me share a screen quickly. So I think firstly, I just want to give you a personal sort of personal experience as sort of a story. As you mentioned, Chinese tech companies are quite cheap relative to their American counterparts, especially after the recent crash. But it's not always what I want to try and convey with my personal experiences. I think to begin with, it's not always comparable. So, for example, personally, for my personal investments, I recently, or a few months ago, we were looking at Netflix, and then when the whole Archegos hedge fund blew up, that was last year. Yeah. We saw one of its holdings, Viacom CBS, crashing quite a lot. Those are both US companies. Viacom today has been taken over by Paramount. So it's got a lot of studios, a conventional media outlet, and it was going big into streaming. So we looked at valuations. Viacom paid a dividend; it was profit making, whereas Netflix still not loss making. So you don't really know how to value it. So on a per user basis, on every single metric, Viacom or Paramount now seem like the better buy in comparison to Netflix. But the stock just hasn't performed. And a few months ago, when Viacom said that they're going to focus on streaming, their share price actually tumbled because their shareholders didn't like it, that they're pushing to streaming. Whereas for me personally, as an investment, I was buying a streaming company that was much better valued than Netflix. So I think what I'm trying to say with this personal experience is that it's not necessarily always accurate to compare to. And with China and the US, it's also very, very different. So a while ago, there was a tech blogger on Twitter that said something that was very, very interesting. So I think she said, I can't remember the name of the person, but she said at the time, in Europe, especially for the tech sector, she said that in Europe, they regulate and never innovate. In China, they innovate, then regulate. And in the US, they innovate and don't regulate. So that's actually...
I think that's got the truth in that. I think that's true.
So it's pretty accurate reflection of the areas. I mean, when last did you see any sort of innovation come through any European market, because there's massive regulation there. China and the US in terms of tech started off on similar footing. For example, Alibaba. I mean, if you visit China these days,
sorry, Tian, just to interrupt you, but I see you kind of your camera angle is moving. So yeah, if it's
is this fine?
I don't know what's. Yeah, it's fine. Okay. All right.
Okay. So what I wanted, let me carry on.
So you're just saying about America and China. I think Alibaba, the way they innovate.
Yeah. So if you look at the past decade, how China went from a cash society to sort of completely cashless and even cardless society. So in the West today, they were pretty much cashless. I mean, when you go to the shops, you just swipe your card. Whereas in China, I never take my wallet with me. I never use a card. Everything's linked to my phone. Everything's paid electronically. And when Alibaba started, they actually needed so much backing from the government to be able to push through sort of the collective bargaining power of the banks. In China, all the big banks are state-owned, so it's easy. Whereas if you look at the US, even in South Africa, if we look at the popular apps that we use today, for example, SnapScan and Zapper, those sort of QR code apps that we use in South Africa, you can't bypass any banks. You have to link your credit card. You have to link your bank card. You can't bypass it. And we obviously, I think that's one of the key reasons why, in terms of e-finance, there's not as much innovation in the West, because it affects the interests of an existing industry. And that becomes a big barrier to entry into the market. Whereas in China, the government really sort of handheld innovators like Alibaba and Tencent. So now in China, pretty much everything you use is Alipay or Tencent WeChat wallet. So they were given a long time to innovate. And 2 years ago, 2020 was the year when they came out with regulation to try and regulate the industry. And we believe it's quite healthy. So the reason why a lot of the regulation are anti-monopoly related. So Alibaba and Tencent, the companies became so big that if any meaningful competitor came up, any meaningful startup came up, they would offer to buy the companies. It's not just an offer to purchase, because for any new tech startup, you have to either be in either ecosystem. You either have to be in the WeChat ecosystem or you have to be in the Alipay ecosystem. Without these systems, you die. So when Alibaba or Tencent come with an offer to buy, it's to buy, but also to offer you a lifeline. And what the Chinese government is saying is that the platforms cannot be closed architecture. It has to be open architecture. That's probably some of the most significant regulation that's come out that affects future earnings expectations. But we feel it's positive for the industry as a whole in terms of overall innovation and healthy competition. If you look in the States, when there's no competition to Google, Amazon, etc., and it's tough to push on regulation there because there's so many lobbyists that influence Senate, etc. So I'm going a bit off topic now, but back to your Tencent question. I think, and also China tech. I just want to show one chart. During the month of March, there was a massive crash in sort of the China tech. This is a chart for the Hang Seng China Enterprises Index. So it's an index that's listed in Hong Kong, Chinese shares listed in Hong Kong, massively dominated by China tech. So it's got a massive weighting to China tech, and you can see it had a massive crash here, sort of midway through March. And that's exactly when JP Morgan came out with a research note to say Chinese internet stocks are uninvestable. And often when news come out like that,
was it actually due to a major investment manager their comments, and then the market just reacted like that?
No, absolutely no. We don't think so, because the research note actually came out on the day the stocks bottomed, and it rebounded very, very sharply the next few days. So JP Morgan couldn't have got it more wrong more quickly. It was the perfect wrong call, at least short term. short term.
Yeah. And why did JP Morgan say Chinese stocks as uninvestable?
So they cited a lot of geopolitical risks. So geopolitical risks, as so we don't have the full research report. We got news reports on the research report. So I haven't seen the original text. So what the text that we saw was rising geopolitical risks, rising decoupling risks, as in potential for the US SEC to delist Chinese listed companies in the US. But when if we consider those risks, it's not since the beginning of March at the bottom, the Chinese tech sector dropped 37%. So those risks are not enough to affect the tech sector by 37% in a matter of 2 weeks. That's not enough. In our view, that's not possible. So we think there are a lot of market dynamics at play. But I think the core of it is that we believe the tech sector was just overvalued to begin with. So for example, if we go through some of the logic that if we use Alibaba, for example, so prior to the downgrade, Alibaba was rated overweight with a price target of $180. When JP Morgan changed the recommendation to underweight with a price target of either $63 or $65, can't remember exactly, but I think the price was at around $88. Nothing fundamentally has changed. As you mentioned, Kevin, a lot of regulation have come through over the past few years, but the regulation started coming through in 2020, with a lot of it coming through in 2021. So even the newest of regulation, or at least a year old, the markets had 18 months or so to digest sort of regulatory change information. It's not something that happens overnight. So we don't necessarily agree with the logic of the downgrade, but we do believe the Chinese tech sector was very, very overvalued. So if we talk Tencent specifically, I don't have a slide on Tencent specifically because we are quantitative managers, so we don't necessarily focus on single stocks. But if we look at Tencent, today's close, I think, was 373 Hong Kong dollars, if I remember correctly. So today's Hong Kong close was a couple of hours ago. So that in itself is quite still not a cheap price for us, if I can call it. Let me just stop sharing.
Tian, yesterday I read about Charlie Munger, a well-known partner of Warren Buffett. He actually sold quite a lot of his Alibaba shares. He was buying last year, and towards the end of last year, he thought he was buying at a good price, even at a discount price. But then I think that last couple of days, the news came out that he's decided that he's had enough, and he actually sold at a loss, which is very uncommon for investment guru like him. So
I mean Alibaba is definitely cheaper relative to Tencent for us. So I think Alibaba at current price, I think it was just under 100 Hong Kong dollars at close, because we'll see how the US market performs tonight. At just under, I think it's sitting at around like a 11-12 PE ratio, whereas Tencent is something completely different. At today's close, we can't look at the 2021 earnings. So that's 48 cents per share. So that's getting you close to sort of a 70-80 PE. Oh, no, sorry. What's 48 cents a share on 300? So it's a very high PE. Today's close was $373. If we use last year's earnings per share, it's this PE ratio of almost 800. So I was off by a zero there. So 780 PE ratio. If we use the highest historical earnings per share Tencent had as at end of 2020 financial year, that was 14 Hong Kong dollars a share. So when earnings normalize, we can expect earnings to probably go around sort of the 14 Hong Kong dollar territory, and that gives us a PE ratio of 26 to 27, and that would be a PE we apply to a company with a lot of future growth expectations. So when Tencent was at over 700 Hong Kong dollars per share, its PE was over 50. So that's a valuation that we don't believe can be justified for a company the size of Tencent. So they've got their entire business model, or at least the majority of their business model revolves around the WeChat ecosystem. So WeChat is very, very powerful. It's like your Facebook combined with WhatsApp, combined with your banking app, combined with your insurance app, everything. But when you have close to 1.2 billion users globally, when your main market is mainland China with 1.4 billion population, and those population includes your pensioners and babies that can't use, you're pretty much at 100% market saturation. So I'm not sure what sort of growth one can expect. Obviously, gaming has been big for them. And there's been a lot of crackdown on gaming, especially underage gaming. So that's also being regulated. So I think going forward, we can probably expect reasonable growth, but you can't expect sort of the 40 to 50% annualized growth that we've been used to earlier parts of the previous decade. So I think, investors into Tencent needs to really take that into account and make up their own mind as to if they're willing to pay the current 26, 27 PE ratio based on 2020 earnings, or if it's time to wait a little bit more. But currently, market sentiment has been poor. So we've seen continued pressure on the tech sector, even after the rebound since mid-March.
So from what you say, Tian, it seems like you paint the picture that maybe Tencent is X growth. Previously, people were seeing 50%, 100% growth a year. But now going forward, maybe if we look at maybe say double-digit growth, 10, 20% probably is more reasonable compared to what used to be. That seems to be the kind of indication you're punting.
Yeah, I think definitely much lower than previous priced in growth. So we still need to look at 2020 financial results. 2021 was a bad year, so it's nothing. It's way off trend. So when 2020 financial year results come out, we'll see sort of the growth. If we compare to 2020, we'll see if there's any level of growth. So it's difficult to put a number. I mean, 10, 20% growth is still great growth, but I think it's difficult to put any number to Tencent at the moment. Maybe it's an analyst that really focuses on Tencent has more detail, but it's difficult for me to do that. But I think by the end of the year, we'll have a better idea of where Tencent is going relative to sort of its high growing 2020 figure. Then I think there might be a revaluation of Tencent stock.
Right. Okay. My last segment or the question is that can you talk us through your products, the product range, and how can investors, especially investors from South Africa, invest in your products?
Okay, sure. I mean, let me share a screen quickly again. 1 second. So we've got Prescient. We've been in China. We've had our rep office since 2009. Our team moved here in 2016 once the products got big enough. So currently we have 2 flagship products. Sorry, the screen share is not looking good. There we go. Okay. Yeah, so currently we have 2 flagship products. I think everyone in the market is quite familiar with our flagship China Balance Fund. We've got 9 years of track record now. So next year we'll have a 10-year track record. It's done a sort of 15, 16% annualized since inception in rands. So it's sort of close to inflation plus 10 in South Africa for 9 years. So it's performed exceptionally well. It's a great diversifier. It's got a rand feeder. It's available on all major South African platforms. So that's sort of your easy all-in-one China product. So you can put it in asset allocations handled. Currently the fund's around 3 billion rand overall. And then we've got our China Equity Fund. That's more popular with institutional investors. It targets the Chinese mainland CSI 300 index. So very different to your typical MSCI China product. So I know there's a lot of MSCI or greater China products out there, but CSI 300 is quite different, a better diversifier in our opinion. And then lastly, we literally just launched our hedge fund, which is the Prescient China Gear Fund. GEAR stands for Growth Enhanced Absolute Return, but that's a qualifying investor fund only. So I won't say too much about it here, but essentially an extension of our balanced fund, but with more use of derivatives, ensuring a smoother ride. So less drawdown, but it's got a high minimum. So yeah, that's happy to discuss for anyone interested to contact one of our sales team, and we're very happy to share more information on that. So overall, I think that's it. I think in terms of performance, I think balanced fund is something to speak about. So if we look at balanced fund, it's been a very, very tough year for Chinese markets. Over the past year, the balanced fund is down 1.7%, 1.67%.
So this is in US dollar, okay.
Yes, this is in US dollars. So this is all in US dollars. Over the past year, ending 31 March, our balanced fund is down 1.7%, whereas I think MSCI China is down 33%, and China Tech is down 60%.
Yeah.
So
by investing in the fund like this, actually protects you from the downside.
So it's much smoother,
to a very large extent in the
pure equity exposure. So when Chinese markets are expensive, we move you into the bonds. When equities are attractive, we up our equity allocation. So over time, you can see we outperform a static 65-35 benchmark significantly as well. Pretty strong.
And just going back to you mentioned about the feeder fund. So so is the fund available on, say, Ellen Gray platform, Momentum Wealth, Old Mutual Wealth, and Glacier?
Yeah, so it's freely available on Glacier. The fund is also available, I think, on Momentum. I think it's also fully available. On Old Mutual, it's available on Old Mutual International. It's available via Old Mutual's tailored fund portfolios as a model portfolio, and on Old Mutual Wealth to select brokers. So I think we just need to request access, but it's available if your broker has access. On Ellen Gray, it's the same. I think your broker needs to have access on the Ellen Gray platform. So so it's available on all the major platforms. Some open to all, some you just have to request for it. But pretty much all the major platforms in South Africa, we have the fund on.
And Tian, I just want to ask you that with all these funds that you run, do you only invest in companies, Chinese company listed on the Shanghai and Shenzhen stock exchange, or do you actually access them on Hong Kong stock exchange, the Hang Seng? Or do you actually do you have the kind of the scope to invest in companies that's got a lot of exposure to China?
So right now we have full flexibility. So we wouldn't necessarily invest in a non-Chinese company that has a lot of exposure to China. So I think, I mean, that's actually, so it does make sense, but I think the problem these days with large companies is if you look at Apple, Microsoft, Tesla, all of the big American companies, it's hard to find a major company where China is not their number one or number two market.
Yes,
so essentially every big company has a large exposure. So in terms of our mandate, we limit ourselves to Chinese companies, but we have the full especially in the China balance fund, we have full flexibility to invest in the mainland, in Hong Kong, and offshore, sort of in American ADRs, although we don't currently have holdings in ADRs, and it would take something pretty special for us to invest in ADRs. But currently we invest both in the A and H share markets. So as an example, there are some dual listed companies in both Shanghai and Hong Kong. And typically in Hong Kong, we find they are sometimes traded at a discount. And in those cases, we'll always buy the Hong Kong share. When it's traded at a discount in the A share market, we'll buy the A share and vice versa. So that's the approach we would take.
Okay, right. Tian, my last question is that because the whole capital markets, I'm talking about the equity markets, is all subject to American rules, if you so to speak. Because say, for example, I understand that some Chinese companies on America's blacklist. And as a
Yes.
result, fund managers, they cannot invest in these companies because these companies are deemed to have a relationship with the Communist Party or the military of Chinese military. Are you subject to the same limitations? Do you, because I hear that you have a lot of overseas investors, are you subject to the same limitations?
So currently we don't have American clients. So the American sanctions apply to American clients and American entities. So that's firstly. So if we do have American client, we did do an exercise where we looked at indirect client exposure. So certain of our clients may have some American clients. So we looked at our portfolio, and at the time, I think just under 2% of our entire portfolio were affected by sanctions. So typically the companies that America sanctions aren't major listed companies in China. So we only invest in the biggest companies in China, and those typically aren't defense related or anything that's sanctionable. I mean, with the exception of Huawei, but Huawei is not sanctioned, for example. Sorry, so Huawei is sanctioned, but not listed.
Not listed, right, yeah.
Listed. So that's one thing. And then secondly, being a South African company, it actually gives us a lot of flexibility. So we are not an American entity, so we're not necessarily bound by the sanctions. So we have the flexibility to invest. Obviously, we would consider ESG as part of our portfolio construction process, and we wouldn't necessarily invest into the defense sector. Right now, we don't have any significant holding. Well, I don't think we have any holding in the defense sector in China. So that's part of our standard consideration. But being a South African entity, and with the majority of our clients being South African based or European based, we're not necessarily affected by the American sanctions. Obviously, it would become a different issue if Europe begins sanctioning Chinese investments for some reason. But right now, there's nothing that indicates that'll happen. So we're pretty flexible in that front, and we're quite unaffected, and we don't see any significant risk of that going forward.
Right. Tian, thanks so much for your time, your insights. I think that it's always good to speak to someone on the ground and have the first-hand experience, and you understand what's going on. Instead of us rely on the media like your Bloomberg and maybe at times, shall we say, Western media, and they may have their perspective. It's always good to hear from your side and understand how you see things and how you manage money for clients in terms of your China strategy. I just like to, I think I really appreciate, because I know that 6 hours time difference is already evening in Shanghai, and I appreciate your time, and I like to wish you well. And to all the viewers out there who join us live, thanks very much for being with us. And this is also available afterwards as a recording on YouTube. And I like to thank everyone. Until next time. Bye.
Thanks, Kevin. Thanks, everyone. Bye.